Welcome back to the Digital Ledger. My name is DJ, and joining me as always to keep us honest on the accounting side is Jeremy. Today we're talking about something a lot of finance leaders are quietly hoping for, that AI is going to ride into the back office and clean everything up. Fix the close, straighten out the ledgers, maybe even make the auditors smile for once. But here's the reality. AI doesn't fix messy accounting, it exposes it. And if you're responsible for finance operations, that's not bad news, it's actually an opportunity. Because the finance leaders who strengthen their foundations today are the ones who will pull ahead of their competitors over the next few years. While others try to patch weak systems with new tools, the teams that clean up their data, workflows, and controls now will be the ones who can actually take advantage of AI when it really starts to matter.
Yeah, that's exactly right, DJ. There's an old rule in accounting and data work: garbage in, garbage out. GIGO. And with AI, that rule doesn't go away. It actually becomes more important. Because now you're not just processing bad data, you're automating it at scale.
So let's break that down for the folks listening on their way into work. When we talk about garbage in, garbage out in the AI era, what does that actually look like inside a finance team? And more importantly, how should leaders recognize it early enough to fix it?
It usually starts with fragmented data. You've got inconsistent customer names, missing invoices, expense data sitting in email threads, and other pieces scattered across spreadsheets. Then, an organization installs an AI tool and expects it to somehow make sense of everything. But research shows that if just 15% of the training data is wrong, that alone can severely damage the reliability of an AI system. And because AI systems process huge volumes of data, even small errors can spread very quickly.
Right. It's not just that it pays the wrong vendor. It pays the wrong vendor faster than anyone on your team could ever do manually. But there's a practical leadership takeaway here. Before you invest in smarter tools, make sure you're working with cleaner inputs. Because AI won't clean the kitchen for you, it just cooks with whatever ingredients are already there.
Exactly. And there's a real financial cost to poor data quality. Research from Gartner estimates that poor data quality costs organizations about $12.9 million per year on average. Some large companies report losses that reach into the hundreds of millions. And most of those losses come from operational inefficiencies, reconciliation errors, and inaccurate reporting.
Before we continue with the episode, we want to be transparent with our audience. And that is that AI helps support research and shape parts of this episode. But all fact-checking, analysis, and final decisions come from us as humans. We're blending the best of both worlds. Alright, so moving right along. If you're thinking about AI adoption right now, the first move isn't technology, it's visibility. Pick one core finance process: vendor setup, expense reporting, revenue recognition, and ask a simple question. Do we actually trust the data flowing through this system? If the honest answer is not really, that's where the work begins. And the organizations that tackle those issues now are building a foundation that makes every future technology investment more valuable.
And that's where the readiness gap becomes obvious. Surveys show that 88% of finance leaders believe AI will be the most transformative technology in the next few years. But only about 8% say their organizations are very well prepared for it.
Yeah, that's not a gap. That's a canyon. But it also tells you something important. If most organizations aren't ready yet, the ones that do the preparation now are going to gain a real advantage.
Exactly. Controllers and FP&A leaders are under pressure from boards and CEOs asking, "What's our AI strategy?" But if organizations move too quickly without fixing the fundamentals, data, processes, controls, they risk introducing serious issues into financial reporting and compliance.
And this is the mindset shift that matters. AI is not a magic eraser for bad accounting, it's an amplifier. Whatever system you have today, good or bad, AI will make it more powerful. So the real leadership question isn't simply, should we adopt AI? It's whether your finance operation is strong enough to support it.
Exactly. And when teams answer that question honestly, they often realize the next step isn't launching another AI pilot, it's operational cleanup.
Another place teams get tripped up is confusing automation with AI. People talk about them like they're interchangeable, but they're actually solving very different problems.
Right. Traditional finance systems are deterministic. That means the same input produces the same output every time. You post a journal entry and you know exactly what the system will do. That predictability is what allows audits to work.
And AI doesn't operate that way.
Correct. Generative AI is probabilistic. It produces the most likely answer based on patterns it has seen in the data. That's extremely useful for forecasting, analysis, and scenario planning. But it's not what you want driving core accounting entries.
So the practical takeaway for finance leaders is simple. Use deterministic automation for core accounting processes. Use AI where analysis, forecasting, and judgment are involved. When leaders draw that boundary clearly, AI becomes much safer and much more useful.
Exactly. A large percentage of AI pilots fail because organizations try to use probabilistic tools to solve deterministic accounting problems. It's simply the wrong tool for the job.
And when things go wrong, the consequences can be serious. We've seen examples where algorithms mispriced assets or generated completely incorrect outputs. That might be funny on social media. It's not funny in a financial statement.
Display. Exactly. If internal controls are weak, AI can magnify those weaknesses. Control issues typically fall into four categories: technical, operational, administrative, and architectural. If those areas aren't stable, introducing AI can significantly increase risk.
And when those weaknesses become material weaknesses, the consequences are real. Stock prices can drop, audit costs increase, regulators start asking questions. So, the smarter sequence is discipline first, technology second.
Exactly. Strengthen the control environment first. Then identify which processes should be deterministic automation. After that, introduce AI where human review and judgment remain part of the process.
Alright, let's move from what can go wrong to what finance leaders should actually do. Because most teams instinctively say, we just need AI to eliminate data entry.
Interestingly, that's not where most of the time goes. Studies show finance teams spend about 30% of their time creating data. The other 70% is review, approvals, and work waiting in queues.
So the bottleneck isn't the keyboard, it's the waiting room. And that's actually encouraging because improving process flow can unlock a lot of efficiency without adding headcount.
Exactly. Speeding up one step doesn't help if the rest of the process stays slow. You simply create larger backlogs.
So, Jeremy, for leaders who are thinking about where to start, give them that simple playbook you were talking about.
First, clean and standardize your data: vendors, customers, and chart of accounts. Second, map your workflows and identify where work stalls. Third, strengthen internal controls so automation doesn't introduce new risks. Fourth, introduce AI where humans still review outputs and apply judgment.
Exactly. AI should eliminate the miserable tasks: document gathering, repetitive reconciliation, manual data extraction. But humans remain responsible for oversight and interpretation.
And when that balance works well, finance teams finally gain time to focus on higher value opportunities. Things like revenue leakage, tax errors, and profitability insights. That's when finance moves from record keeping to value creation.
So let's land this. If you're a CFO or controller listening today, Here are 3 moves you can make in the next 90 days. First, run a quick health check on one core finance process. Second, automate one clearly defined task with strong controls. Third, set clear guardrails for where AI should and shouldn't be used in finance today. If you do those 3 things, you're not chasing hype. You're building a finance operation that can actually take advantage of AI without risking your controls, your reporting, or your credibility.
Exactly. The real question isn't, can we use AI? It's, can we trust what AI is doing for us?
Jeremy, always sharp. Appreciate you walking us through it.
Thanks, DJ. This was fun in a very accountant kind of way.
All right, we'll leave it there. Strengthen the foundation, then let the technology work for you. Jeremy, talk soon.
Talk soon.